the year of 2026, this friction that we're experiencing right now, well, is it good or bad? And I guess it really depends on how you're preparing for that friction that we already see in front of us right now.
2026, in my opinion, is the prepared individual. Whatever the role is, they're the ones that win. So last week we were kind of talking about this, 2026 being a different year.
Mm-hmm.
And we talked about maybe expanding on it a little bit. And so it's definitely what I want to do. And, I think there's really, I guess when you put yourself in that mindset, there's a lot going on right now.
Oh,
and we
sure.
all know it, right? It doesn't matter if you're, talking about strictly finance or, politics or faith and religion or moral outlook, whatever it may be.
Mm-hmm.
There's just a lot of change.
Yes, there is.
Or at least there's a lot of friction, right now.
Yeah, there's, you said there's a lot, and friction is a good word, right? Because friction can be positive or negative, right? I mean, you put two sticks together, you rub them, and then you get fire, right? And then depending on where you are, like if you're camping, you're a big camper. If it's like the weather we're having right now, that's good friction, right? You want that fire started. But then you put friction into a marriage, friction into a relationship, but then that could separate
or it could make it stronger.
Or it can make it stronger, right? So the year of 2026, this friction that we're experiencing right now, well, is it good or bad? And I guess it really depends on how you're preparing for that friction that we already see in front of us right now. And I think that's why 2026, in our opinion, is a good year for you to really take a step back and understand how are you going to embrace the friction that we already see. Are you going to be the one who ignores it and waits until calamity happens, or are you the one who's going to be more proactive and use it for your best advantage?
And a much deeper, probably more philosophical question to that would be, what does that even look like? How does somebody actually win? And because it goes far beyond just tactics and planning, even beyond what we do, right? Mm-hmm. It's more of having a foundation in how you view life and how you embrace challenges and friction or, whatever the headwind may be. I think what you're saying, it makes me think of a story, an analogy. There actually was a podcast show, it's probably still out there, that kind of starts with this. And it's basically a grandson talking to a grandfather. And the grandfather's talking to him and sharing with him that in this life, as you live your life, there's basically two wolves, one on each shoulder. And, one wolf represents gratitude and happiness and joy and, relationship and just a lot of these positive things. And then the other wolf, represents, hatred, resentment, and just a lot of negative aspects of life, and so the grandson's talking to his grandfather and he looks up and he says, Grandpa, which wolf wins? And the grandfather looks down at the grandson and says, well, it's the one you feed. Mm. And so, in a world like we live in today, and I can't, I stress this out to my own 3 boys extensively. I'm like, look, you have got to really, truly think for yourself and then question the way you think. Consistently with the, of course, what we believe would be the only source of truth, right? The only foundation of truth. But to pull it into this 2026 and all this change, you really, I think that matters, whether it's you're running a business or you're leading your family or, you're looking for opportunity or you're trying to navigate challenges. When I look, we do a thing every year for our clients, a big event called Night of Gratitude. And, we talk a lot often about how gratitude's really just a state of mind, right? And there's so much benefit that comes from that. Well, when you look out into a year like this year and all the things that are happening, I think having that foundation and kind of that aim, if you will, at just the future in general, it really sets a strong way of navigating these uncertainties and all of these challenges that we may face and all the opportunity we may face. Mm-hmm. So, not really a finance segment, but kind of a way into that because it does matter.
It does matter. It does matter. Yeah, I mean, your way of thinking, your mindset about your finances, you have to just take a step back and look at reality. I think that's one of the things that can set people back, is that they're delusional about where they are financially, and the sooner you can just embrace that the past, the only reality that you actually have is the present, right? The past happened already. You can't do anything about it, and the future is never promised. It's the only thing that is the only reality that you actually have is the present. And so you have to just be able to just take a step back and be realistic with your financial picture right now. And not just your personal financial picture, but just the economy, the markets in general. Not what your bias is, not what you would want it to be, not what would you like it to be. What are the opportunities that are presented to me right now in relation to my financial picture right now? And then what do I need to do to be the best? Well, what do I need to do and implement to make sure that I'm taking advantage of all the opportunities in front of me to put my finances, my business in the best potential, in the best, I guess, uh, lane for success. And right now, I think what's in front of us, one thing, there's many things that are in front of us. Like you mentioned, all the friction. I'd say one thing that's in front of us is this environment of interest rates, right? I mean, Powell just basically said we're going to we're going to pause interest rate hikes or cuts. We're just going to stay level right now, not make any changes. Now, our president in charge is not a big fan of that, right? He wants a
It's
little
not
more.
going to last.
Yeah, I mean, Powell's done in May. I mean,
Yeah.
it's pretty much done. And I think there were two. I think there were two Fed members that were in favor of two cuts. Well, two members that were in favor of a cut. But Powell, man of his word, in a sense of he's not going to rush, right? He's not going to rush because the data's not out now. You can be on one side of the table or not, but actually what's presented to you in front of you right now are that rates are going to stay the same where they are at least until the next Fed meeting.
Yeah.
So with that being said, what do you do?
Yeah.
What do you do with that information? That's the reality. That the rates right now are 3.5 to 3.75%. It's not going to be any lower until possibly the next rate cut.
Yeah, I think you're right. So a dropping interest rate environment, and us really basically boldly saying 2026 is a dynamic, pivotal year. And it's the combination of various factors. Let's say, this interest rate being the first one of it. And so, yeah, what do you do with that?
Yeah.
The truth is the cost of capital has improved, and at least appears like it's going to be improving for the season. Beyond 26, who knows? If 26 really is the dynamic year that we expect it to be. And of course, maybe just a change and a start of a new life, if you will, a new world, a new economy in many ways with, what can happen this year and leading into 27. So what do you do with that? We talked about a little bit last time. I want to expand on this for a second. What happens when rates drop? As a consumer, I think it's true. I think capital is becoming cheaper. Of course, the lenders will become more selective, but the problem with all this is not that there's not going to be opportunity. The concern that I have for people is that it's going to be bad opportunity. The concern that I have is that what happens when rates drop is you get this like financial candy, if you will. You get these banks and institutions that begin to, drop these nice, attractive options in front of the consumer in a way that really creates bad opportunity and bad decision making. In a world where really you could actually shift into very good quality decision making, once again, if you're prepared for that. And so this interest rate drop and expectation of potential continued drop, I really do. I think it creates opportunity, but I think the fight back is bad opportunity. And I think how you navigate that really is dependent on, the decision making you've had in the past. Are you a knee-jerk reaction type of person? Are you an impulse type buyer? Is everything you do in the way that you shop dependent on what you can afford on a biweekly basis because of your paycheck coming in? how do you make these types of decisions? And I think you need to question yourself now to make sure that you're not, chasing the lure. For my bass fishermen friends, it's supposed to have bass tournaments, so it's way too cold. But the reality is you don't want to chase the bait. Drop sinker line, you're out.
Yeah, bad opportunity, right? So, we touched on it a few weeks ago when the proposal of cutting credit card interest or capping credit card interest rates to 10%. Okay, so that's an opportunity that's in front of basically everyone if it does get passed, which it's still out there in talks. But what do you do with that, right? So for someone who has found themselves in a massive amount of credit card debt and 20 to 30% interest rate somewhere in that realm, well, now there's an opportunity here. These credit card companies are going to reduce your if this passes, the most they can do is 10%. So what do you do with that? Do you say to yourself, oh, this is an opportunity for me to, if my minimum payment, whatever I was paying was $1,000 a month, now really all I need to do is pay $500 to stay on the minimum. Do I keep paying the $1,000 because now that extra $500 is actually doing some work on the principal and is bringing your balance down? Or is this a license for you to say, well, my gosh, I can keep spending more?
Right.
I didn't max out my credit card limit. I just have a big balance, a large balance. But guess what? Got spring break coming up. Got Valentine's Day coming up. I've got summer vacation coming up. Well, let me just charge another 5, 10, 15 grand. And the most they can charge me is 10% interest. And I'll worry about it later. The opportunity is there. I would say, I think you said smart opportunity and bad. And instead of bad, I would say dumb. Right?
Yeah, right.
Yeah, smart opportunity is let me go ahead and get myself out of this debt cycle that I'm in, or that's a good opportunity. Dumb opportunity is now this is a license to chase the lure, chase more money, chase things I don't really need, and I'll defer it to later.
Yeah,
and that's just ridiculous.
So I you're 100% right, and I'd go back to like the first part of this conversation, which is like really understanding what you value. And a lot of times we lie to ourselves. Like we say we value whatever relationship and whatever it may be, but then our actions don't follow.
Yeah.
Right.
I like how Pastor James. I don't know, you keep going, but I don't know if you were going this way. But remember, Pastor James says, if you really want to know someone's value, look at their bank account.
Oh yeah. Yeah, I love Bass Pro Shop. I value that, and I don't even hide from it. Like it just is what it is. I value Bass Pro Shop. Actually, I'm not. But anyway, no. So but that's important, right? Yeah. It's important to once again be transparent with yourself. Now let's go on to the business owner or the executive and a lot of the clients that we work with, right? How do you win? And how do you take advantage of this first piece that we're talking about, which is just the drop of interest rates, and then we'll move on to the next one. And if you're a business owner, there's still the same risk. There's still the candy, if you will. And I think a lot of this is maybe not pushed just by institutions. It's pushed by sales representatives and or a variety of just different commentators online and stuff like that. The problem is for a lot of our clients, especially the ones that own small businesses or the ones that maybe are real estate investors, they're getting a lot of this eye candy of like, hey, you need to go buy real estate, depreciation's back up to 100%, you need to implement this tax strategy, you need to open up a nonprofit or a family foundation, you need to do whatever it may be, right? You should be owning, different LLCs, recreate infrastructure, pay yourself, pay your kids, like all this stuff, right? And the problem is a lot of those things are actually available for implementation, right? You can execute. The problem is not all of them you should. Right? So like I think about, some of the business clients that we work with, and the problem is most, if not all actually, clients that come to our firm that hire us, small business clients, it's always last minute, given to us by a CPA or given to us by an accountant, that, hey, look, we've been working with this client for quite some time. What they need is really some guidance on how to quantify the value of this transaction or how to quantify the value of buying this purchase and depreciation or whatever. And so we jump in there. It's always last minute. It's always last minute, right?
Yeah.
I need to hide money from the IRS, which theoretically everybody wants to do. And it's not like hide money. It's like you use actually IRS laws and tax laws to
Right.
prevent them from getting it. So the reality is this, though, is that all this kind of comes to a head this year, and it may be, continuing forward because companies know they should be investing, which will be one of the topics we talk about here in a second. They know they should be, reinvesting capital in their business. Now they could borrow capital. And so it's like, okay, here's the equation and the formula. Do you know at what rate is the right rate to borrow at to make a big purchase in your business, to potentially accelerate some type of cycle or depreciation to reduce net taxable income, and where that variance and that balance is? How much do I have to borrow and at what rate? Can I actually cycle it through a product or something that I need for my business, infrastructure-wise, to reduce the tax liability to cover the cost of the note? And it's like, okay, if you've really prepared for that, you could take advantage and be a winner here. Or you could go borrow money cheap, buy the truck you want, and actually do nothing for your business.
Yeah.
So it's like it could go both ways.
Yeah, and that's why I think that's why a lot of clients, and we've heard it multiple times, why they work with us is because their advisors, whether it's their CPA, their tax accountant, their bookkeeper, their accountant, and maybe they have another financial advisor somewhere else. All of these relationships are kind of working in a silo fashion, right? So your CPA is telling you to do this, but the CPA is not talking to your financial advisor who's telling you not to do this, or here's the level to fund it. But your bookkeeper is just keeping records of, the transactions and, making sure that your books are right, but isn't informing the CPA about maybe a transaction that needed to be categorized the right way. So your CPA is waiting till last minute. They're only worried about you're reducing your taxes for 2025 that's already passed. Your financial advisor is thinking about 2028 when the new administration may come in and what that might do to your taxes. So no one is working together, and it's like this fragmented operation that's going on with really you as the business owner trying to manage this. Right. And so clients look at us as, okay, I'm tired of this fragmented advice that I'm getting. Right. Sounds like good advice, but is it really what's best for me? And so clients look at us as saying, okay, we want you, Asset Management Group, to be the coordinator of this all. Whether you do it all in-house, which we have the ability to do, or, I like these guys that I work with, but I need someone beside myself
To pull it together.
Yeah. And for 2026, that's even more powerful than ever because there's so much going on, and you need that coordination.
There's one end result to fragmentation, and that is a disconnected, missed, opportune year. I mean, that's what will happen, because once again, it has nothing to do with the individual expertise of the different roles that you mentioned, right? When it comes to advisors, tax accountants, CPAs, EAs, like whatever it may be, bookkeepers, they all do their own work within their own respective field, as they should. The problem is how you get so much mixed advice because the angle in which they approach your financial, especially as a small business or like an executive, it's like there's so many moving parts, and so this is why you even engage with so many different professionals, and then as a result, you get this fragmented problem that we ultimately solve for people and for companies, and it goes all the way through tax returns and group benefits and et cetera. In a year like 2026, where companies are having to make and should be making major decisions, it is definitely a year where you can't be fragmented. You can't, because what may look as the right thing to do for your business, maybe what makes sense from the tax professional view. You can do this and reduce your taxes, but maybe your financials, your books, your P&L, and your balance sheet, maybe that doesn't support it.
Right.
Okay. Or maybe your personal financial life, it doesn't make sense for. Right. Yes, you could do this, reduce tax, but that's not what's needed for your financial wealth. Right. So this cohesion is necessary in 2026, and I think that matters when you're talking about taking advantage of interest rates. And then, of course, I think we got to throw in the retiree here.
Oh yeah.
Okay. So like interest rates with the retirees. Well, we've seen it, right? Since 2020 moving forward. We went into this season where interest rates really, post-COVID, 2022, inflation, interest rates started to rise. What happened? Well, we started, as well as clients, take advantage of fixed investments, cash investments, right? Shifting money to high interest savings accounts, shifting money to CDs, shifting money to money markets, I-bonds, right? I mean, but why not?
Why not?
We
Yeah.
took advantage of it all, just like everybody else for
Yeah.
our clients, because at some point, you gotta look at the cost of risk, and the reality is when you can get a 7-8% on an I-bond,
Why not?
right? That's risk free, or you can go put money in a CD at 5.25% for the next 12 months. It's like, okay, look, at all respect, our job is to do what's best for our clients, and there's a portion of their money that should be conservative. Well, you can get risk free over conservativeness at that moment at a better rate. So it's like,
Why not do it?
Why not do it?
Yeah.
That's not the case right now, and it's not going to be the case if rates continue to drop. So we're, once again, another weird dynamic. So what do you do with that? Well, once again, we were talking about like good opportunity and dumb decisions, or dumb opportunity. Well, what you don't want to do is knee-jerk react and jump into something that may not just be what's best, because you don't have a plan. So you're sitting here with your CDs that are renewing from 2 years ago or 1 year ago or 3 years ago, and you're like, well, renewal rate's not that great. What should I do? I'm just not going to worry about it. Locks in for another 2 or 3 years. Okay, that's stupid. Right? Why? Because and it drives me nuts. And people are like, I'm like, look, I don't care who you are. I don't care what business you own, how much money you have, what investments you participate in, what family, estate, or foundation you're a part of. It does not matter to me. Someone is always winning. Always.
Yeah.
Always. Okay?
Totally agree.
This
Totally
is like the complexity of Vegas, right? Vegas with a whole different dynamic and complexity layers to it. Because when I say someone is not just the house, the casino. Someone in our world is an institution, such as maybe a bank. Could be a 401k provider.
Yeah.
Could be a ETF or mutual fund company. It could be a fixed income product. It could be the bank. It could be the IRS. Right. At the end of the day, someone is always winning. And so when you don't take time as a investor, and we're talking about like someone that's retired or about to be retired, but regardless, anybody, if you don't take time to think about how does this benefit me, and am I benefiting at a greater level than anybody else in this deal, because this is my hard-earned money, you lose. Period.
Yeah. No, it's really quick. It's not really a finance thing, but it kind of is. Not a big fan of her, but I'll say it anyway.
Hillary? Oh, sorry.
No.
My bad.
Close. AOC. But I saw a little clip of her, and she was talking about CVS, the pharmacy company. They own, I don't think it's Aetna. They own another Medicare company. Then they own CVS Pharmacy. Then they own the primary care. And it's like this wheel.
Oh, yeah.
And so she had, I think it was the CEO, CFO of CVS was in front of her. And she was like, this is almost a corrupt wheel. Because where does the patient win in all this? You're controlling the medication. You're controlling where they get the medication. You're controlling who they see. And you're just controlling this entire market. And you own every single part of that patient's cycle. And I was like, I didn't know that. Like, I didn't know CVS owned all these different affiliate companies and everything of that sort.
Oh, yeah.
And so, no matter what decision that patient makes, who wins? CVS does, because they own every hand of it. And you're right. Everyone is going to win. And unless you put yourself first as the investor, as the retiree, as the consumer, whatever it is, as the client, then someone is going to not necessarily take advantage. That's not what we're saying, but someone is going to have the advantage over you.
100%.
And you've got to be able to, weed through the noise and understand for 2026, not just 2026, but specifically as we're talking right now, what do I need to do to make sure that I'm the one who's at least participating in this? Because if not, then I'm in the back seat.
And what you have to do is you really have to begin to think, like think, you know. I really do believe that the end result, a lot of the decisions that we make is because we're so inundated with, not always useless things, but we inundate ourselves with, constant news and constant social media and constant videos and reels. People are watching us right now, right? So I better be careful. But in all honesty, right, we inundate our stuff with so much that we don't even allow time for ourselves to think, to be able to make wise, well thought out decisions for ourselves. And I think that matters even more, right? Yeah. And which is the other factor of this year is like everybody knows, right? We're talking about AI. The average individual citizen of America knows how to use it, in some capacity. Various levels, are dependent on your experience or whatever. But the truth is like Elon was talking earlier, just a few weeks ago at the summit, and he made a statement that, I don't know if you caught this, but that the closed market AI right now is running about 12 months ahead of the existing open market AI or open AI. And so I was thinking about that. I'm like, okay, well, I don't know if this is a great gauge, but think about where you were 12 months ago with AI. Where we were 12 months ago, right, and everybody else. Well, a good bit of the population, at least statistically, wasn't even using it yet,
right?
Or like just the simple platform of OpenAI. And so now you think 12 months later, it's almost a household item. It's almost available in schools and in every platform, and all these different companies and technology has now risen, if you will, from that. In the last 12 months.
Yeah.
Okay, now you consider the compounding effect of AI to be able to work on itself. So I'm like, I know where we came from over the last 12 months and how quick in advance that was. I could only imagine what the release is 12 months from now. Like what's available right now in closed markets and not available to the general public. And so when we think about, 2026 and dropping interest rates and how to take advantage of different seasons of life and, a quick and, advancement of technology, this whole thinking concept is like, you have to, because if not, the digital world is becoming more and more the sponge or the source of what we call truth. And that is very unnerving. Very unnerving. And so when you're thinking about your life, your financial decisions, every part of your life, but in this world, like what we're talking about, your financial decisions, you need to really use it,
right?
Benefit from it, but you got to think through it yourself too, and not just take everybody's word for it.
Yeah. So practically speaking, so you mentioned retirees, right? So if you're listening right now, and you're watching us right now, and let's say you're in the season of life where you are, I don't know, let's just call it 65, 66 years old, you just retired. That's about this. You're retired in 2025. You're listening to this podcast, and you're hearing these two guys say, oh, this is the year of advance. This is the year I need to take advantage of. What are some practical things a retiree should think about truly with respects to, again, we talked about interest rates, but let's just say interest rates. What should a retiree think about, and maybe even implement? Right. I mean, obviously, everybody's story is different, but what should a retiree really think about, and maybe think about implementing within their life right now?
Well, I would say preparation is the key.
Okay.
Right. So 2026, in my opinion, is the prepared individual, whatever the role is. They're the ones that win.
Okay.
So when you're thinking about opportunity with either borrowing to enhance your position in a particular investment like your business or whatever it may be, or you're looking at borrowing with interest rates dropping as a opportunity to refinance and reduce the liability, preparation in both of those scenarios makes sense. So like the math problem that we're going to try to solve is, how do you prepare for that? Well, we look and examine and audit exactly what you're doing today, right? This is math, right? Numbers don't lie. So if we can very clearly articulate and identify exactly the arrangement you have with the institutions you're working with, and we understand the debt and the liability that you have or the investment that you have, then we can very easily factor the exact rate that should be the rate or pivot rate that you actually go in and execute upon. So you see all these teasers, no part of this, or you're having a drink with a buddy who's a banker, or you're whatever it may be. You're trying to figure out how to save money because your cash flow is tight, right? You don't prematurely jump the gun. You know exactly what rate you're shooting for, the expectation of that rate possibility in regards to like the Fed's dropping rates, and when it gets there, you execute.
You move.
Right, you move. Same thing with your business, right? And so with rates, I think it's very much a math-driven, quantifiable problem that has to be solved. But preparation's key.
Yeah, I mean, I think one of our notes said, the post 1982 rate cuts, basically those who refinanced and reinvested prudently created long-term wealth.
Yeah,
and I think one of the key words, the key word to me was prudent. Like you don't rush into anything. You be prepared. Going back to what I said originally, face the reality that's in front of you. If you're a retiree, you're entering a new season of life where all of a sudden you went from exchanging your time and energy for cash flow, where now you are using, 65 years old, maybe a portion of if your income is Social Security, if you decide to take it then, maybe you're lucky enough to have a small pension. Okay, so that's the baseline of your income. But now instead of trading in your time and effort for cash flow, you're generating income from your investments, right? And so the decisions of how to withdraw, the decisions of which assets to withdraw from first, how do you strategically withdraw from all these different assets, whether it's a Roth account, traditional IRA, 401k, individual brokerage account, whatever it may be, you don't just hastily start pulling money out, right? That's a recipe for disaster. So yeah, being prudent about where your cash flow is going to come from, and most of that is being prepared. For the most part, it's being prepared.
Yeah.
And I would say the retiree who has entered retirement in January or February of this year, I don't want to beat you too bad, but like the preparation shouldn't be in January. Preparation should have been January of 2025,
for sure.
Maybe even 2024.
Yeah.
Right. For knowing that I'm going to retire in 2 years, I need to know what my cash flow is going to look like, where it's going to come from, which assets I'm going to sell first to generate my income.
Yeah.
Right. So,
well, and that goes to another 2026. How do you prepare? You should, for every investor, you should absolutely embrace right now a true reset of understanding your risk ability, your tolerance. I'm not talking about your emotional tolerance. I'm talking about your financial plans of tolerance to accept and navigate risk. And I think that's huge. I think you got to do that right now. And I'm not saying because doomsday's coming. I'm just saying because, if you don't analyze your own actions, you tend to buy into this, false concept that I must be doing everything right. Well, theoretically things are going well because the market's been well, right? And things have done well, right? Not because you just happenstance to make the right decision. You need to reanalyze your ability to accept risk, how much risk you can accept, restructure risk within your plan for that formula to be able to navigate continuing going forward so that you continue to be successful, regardless of what the future holds.
Right.
So I think that's another just general factor for the investor that they need to, a practical measure they need to do.
Yeah, one of the things that we do for most of our clients that are retiring, not that this is a secret sauce, but this is something that AMG really believes in wholeheartedly, especially if you're retired, that we know where your income is going to come from. Right. We create accounts where for the next 12, 18, 24 months, depending on the risk of the client and the risk their plan can afford to take, we have identified exactly where your income is going to come from for the next 12 to 24 months. And what that does for our clients, it gives them a peace of mind, knowing that for the next 12 to 24 months, again, depending on the client, that if interest rates go up, if interest rates go down, if the market goes up, the market goes down, the market goes sideways, we've already prepared for the next 24 months of your income.
Yeah.
And it is so reassuring, not for just us, right? Me selfishly, it's reassuring for me because I'm not concerned about my client's income because of what the markets do.
Right.
But the reassurance that the clients feel on the other end
Yeah.
when they tell us, oh my gosh, Mel, thank you.
Mm-hmm.
Andrew, thank you. Those meetings are different meetings when a client looks at their balance sheet and they can literally identify, okay, my income for the next 2 years is coming from there. It's safe. It's protected. Are you sure, Mo? Yeah. It's completely protected.
Yep.
Wow. I mean, that is, when I say it is so reassuring for me and for the client to know that and
Well,
identify
it's
that.
just foundational,
It's
and
preparation.
I think, yeah, it's preparation. It's like, at the end of the day, a house doesn't get built without skilled workers with a very clear description, a job description of what they need to do, right? A financial plan will never be successful unless you have a clear set goal for specific parts of your assets to do specific jobs within your plan. And when you do that, if you're like, if I would say in general, if you're someone out there that looks at, your investments and you're like, well, I've never thought about like a job description. Like, what exactly is this? All I see is, one IRA with $4 million in it, or one brokerage account with $2 million in it, like that. I don't know what that means. That's a problem.
Yeah.
Right. My expectation is that through understanding a flow and literally a visual flow of how money moves in someone's life, that the client can actually say, no, I know the job description of this account. This job description is XYZ. Well, what that does in turn is, well, then the expectation is XYZ. And so as long as we're all on the same page on expectation for this job and for the responsibility, it creates a successful relationship and so forth all the way through all that they have. So it's a year to think. It's a year to prepare. And if you do those two things right, it will be a year of opportunity. If you're caught up because you're busy, which I understand, right? Life is busy, family, kids, activities, whatever. But remember, if you are the head of your household and you are the one that people look at to carry the decisions out and to make wise financial decisions for your family, I will tell you right now, like literal, the decisions you make now will have compound effect for the rest of your life, no matter how old you are. Okay? And the older you are, it will have generational impact. The younger you are, it'll affect you and your wife or whatever it may be, your family's life. Small decisions. Okay? This candy we talked about, you go chase it and you're like, man, I want that. That's a good deal, right? Let me upgrade my car. Let me upgrade XYZ. Let me do this, whatever. And you go and you sign the dotted line. We're talking literal effects for the rest of your life. All right? So think, slow down, process. 2026 is a year. It's a pivot year for so many families, but I think it's a year of huge opportunity. You just gotta be prepared for it. Wow. So we good with that?
Preach on, brother. Preach
All
on.
Right. All right. Well, listen, you guys got to stay with us. Don't forget, just on another note, me and Mo, we try to release a lot of high caliber, high quality, I know it's in depth, but just educational content on various topics, whether it be, real estate investing or understanding tax laws at a different level. We were just recently put out a series on depreciation and how to take advantage of this big, beautiful bill from a depreciation perspective. The truth is, once again, it goes back to that thinking. If you take time, embrace our resources. We're trying to get them out there to you. Don't hesitate. If you got topics you want to learn more about, like send it to us. Let us know. We want to make sure that we give you what you need so that you're able to think for your own self and your own family to make quality decisions. So once again, we always appreciate you guys. Share our content, and we'll see you next week.